You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means it is time once again for a little program we like to call Around These Parts. TWIFO, This Week in Futures Options, a program where we break it all down. What's lighting it up on the other side of the options fence? Going to talk some commodities, maybe some equities. You never know, some crypto. Never know what's going to make it onto the show. That's why you have to tune in every week. My name is Mark Longo from theoptionsinsider.com, of course, from the ever-exciting, ever-evolving Options Insider Radio Network. Glad so many of you have chosen to join us on the Odyssey that is Plus and Pro out there. A lot of great content coming at you on those, including those great Pro Q&As. A lot of you have loved Options Oddities every Friday, a whole bunch more. Got those live stream servers for you so you can join us live throughout the week, and a whole bunch of other fun stuff to come, like we said. Kind of just getting the ball rolling. Where do you go to learn more? theoptionsinsider.com/plus or/pro. That'll get you to where you got to go. If you want to see them both side by side for a comparison, just go to theoptionsinsider.com/shop so you can analyze at your leisure. If you have any questions, hit us up. In fact, just keep hitting us up with all of your questions out there. We'd love to hear from all of you guys and gals out there today. And this is usually the portion of the show where I toss it to my friend, my compatriot, my partner in all things futures options crime, beaming at us from the FTSE Russell studios, but not, I think, this week. Listeners, no. We are joined by a newcomer, not really to the show or to the network. He's been on once or twice, but going to maybe add him into the rotation a little bit going forward here in the old FTSE hot seat. Our old friend, Mr. Russell RHOADS. He's done a few things out there in the space. He's worked at a bunch of venues, been kind of an equities derivatives researcher over there at a bunch of venues, including SIBO, and now over there at EQ Derivatives. Written a few books VIX Trader's Handbook, Trading VIX Derivatives, Option Spread Trading, Trading Weekly Options, Option Strategies for Advisors and Institutions. He now hangs his hat over there at the Kelley School of Business as a professor over there. And of course, most famous of all, he was even a guest on our third Pro Q&A session last week. Mr. Rhodes, welcome back to TWIFO. Have you recovered from the epic fun that was your Pro Q&A session, sir?
I have, and I really did enjoy that. I could spend an hour just doing nothing but fielding questions. I think it keeps you on your toes. You're definitely addressing what everybody's interested in. So I think you guys adding that to the rotation was a really good idea on your part.
And I can confirm that our listeners did enjoy it, and we may have a few more readers of your books as a result, sir. So there you go. Selling books left, right, and central.
That's right. I will send you 10% of what I get from the book. So, you've got to check for $1.20 in the mail.
68 cents. Oh, $1.20. That's even more. That's double what I was thinking. So there we go. I am a wealthy man as we kick things off, as we are wont to do, listeners, with the Movers and Shakers report.
It's time to find out what's rallying on the light side and falling to the dark side at CME Group this week. It's time for the Movers and Shakers report.
All right, everybody. This is, of course, the Movers and Shakers report, where we kick off the show by explaining and looking back on what the heck has been moving to the upside and to the downside, aka the light side and the dark side, over the past week at CME since our last show. Of course, you can get this report. We tweeted out. The folks over there at CME always put it out before the show as well. So if you follow them, you can see it. And Mr. Rhodes, this is usually where I toss it to Sean, and he usually says light side. And so we start there. But I shall now give you the same opportunity, sir. Where should we begin our journey this week?
Well, since I'm the anti-Sean, let's go dark side.
Okay, you picked an interesting week to do so because there's about 4 dark side on the list this week. not a little more than that, but not much more. It is mostly, I would say, over 2/3 to the green side of the screen this week, listeners. Let's go dark side. Let's go to all the way at number 5 to the dark side. So you're kind of talking the scraping the bottom of the barrel now. We've got oats back to the ags off 1.3%. Then we jump up a little bit more respectable to number 4. Soybean meal, giving it up to the tune of 4.59% this week. Then number 3, a name that moves a lot to the upside and to the downside. It is Bitcoin. Guess which direction it moved this week, listeners? Yes, to the dark side, off nearly 10%, 9.61%. If you've been following the headlines or not living under a rock for the better part of the last week, you know we broke the 30,000 handle out there. So for a brief period, everyone who owned Bitcoin this year, everyone who bought it this year, was underwater. So it was a crazy time, down year to date after the insane year that has been out there in crypto. ETH broke the 2,000 level, so a lot going on out there in the world of crypto, and that translates to Bitcoin on number 3 to the dark side, off nearly 10%. By the way, it was number 2 in the other direction last week, up about 5.25% last week. Number 2, out to the livestock again, lean hogs, off nearly 10% as well, 9.89%. It was number 4 in the same direction last week, off 7.3%. So a rough couple of weeks for lean hogs. And number 1 to the dark side, it is Eurodollars, off 12% exactly since our last show. So interesting run out there. Let's go now to the upside. Let's go to number 5 to the upside. Heating oil, number 5, up 4, almost 4.25%. Number 4 is good old RBOB, up about 6.2%. Number 3, it's not a rough week for rough rice. It is a good week for rough rice, up 8.54%. Number 2, soybean oil. We've been talking about this a little bit on the show of late, up nearly 9% this week, 8.93% to the upside. It was number 2 in the other direction last week, off an impressive 16.09%. And number 1 with the bullet this week is platinum, out to the precious side, up 11.07%. So Mr. Rhodes, quite a diversity of complexes being represented in our movers and shakers. We got the ags, we got the crypto, we got the rates, we got energy, we've got metals. It's kind of a pick your poison. So, sir, I ask you, beaming in for the first time there from your version of the FTSE Russell Studios, where should we begin our journey this week, sir?
Oh, gosh. Do we want to take a look at Eurodollars since they were down so much?
How did I know you were going to go to
I just always like to talk about the interest rates.
You're kind of just that guy. You will always say rates, even if they're unched on the week. So let's do it, listeners. Let's kick things off in the world of rates.
The Fed, the yield curve, inflation fears. How are they impacting options activity and volatility in your favorite interest rate products? Let's find out as we explore the world of rates.
All right, listeners, welcome to the world of rates. We're going to kick things off out here in the big dog, of course, Eurodollars. You know where to go to play along with the home game, CMEgroup.com/TWIFO, TWIFO, or /TWIO, TWIO. Both of them will get you out to our report, of course. Then you head on out to the interest rate section, go to U.S. rates, and then Eurodollars, and that shall begin your journey along with us. Interesting journey in the world of rates over the last couple of weeks, Mr. RHOADS. Of course, we had the Fed come out. We actually had some live analysis going on of the FedWatch tool right as it was changing mid-show, which was kind of fun. Wasn't on TWIFO, one of our other programs. So still fun to watch all that impact. Then, of course, since then, we've had kind of rogue Fed governors coming out and spooking everybody, yelling, kind of spooking people today, saying, you know, we got to watch out for that debt ceiling. Otherwise, issues could happen out there. So a lot of things have been popping off in the world of rates since you last joined us, Mr. RHOADS. What has been lighting up your tape in rates, in particular in Eurodollars, sir?
Just the fact that we, like you said last week, we finally settled. I think we settled the question last week as to whether or not we were going to get a rate hike in 2021. There had been a nice trend with. I love the CME FedWatch tool, by the way, and there had been a nice trend where it looked like they were eking in. The probability of a potential hike was increasing. It was still really low, but the trend was toward a potential rate hike, and they slammed the door shut on that, didn't they? If you were watching it live, then you definitely saw the target rate at 0 to 25 basis points going right to 100%. Because nothing's going to happen for the rest of this year, which I find interesting because weren't they always indicating it was going to be a couple of years before we got a hike? Was that not?
Yeah, that seemed like that was common knowledge to me, but apparently that surprised people.
I'm scratching my head on that one. But yeah, which means this will probably be the last time that we want to talk about any volatility whatsoever in rates until next year, right?
Pretty much. You're going to be a very bored man on the show, sir. No more rates.
I know. No, I'll stop saying rates after today. But because of the week-over-week action, I figured it probably was something worth bringing up for sure.
Yeah, the FedWatch showing a rare 100% probability of no change throughout the rest.
I know.
Very rare do you see that out there, but you're seeing that right now at CME Group FedWatch listeners out there all the way through the end of this year. It was kind of fun watching it live, Mr. RHOADS, because it was all of a sudden, I think they're pricing in about a 7% probability. Then as they started talking, all of a sudden started gapping around. Next thing you knew, it was 17%, and it was starting to get up there. It was no longer a de minimis possibility that things were going to change. And then you're right. Now we're back to 100%. So if you're not watching the Fed Watch, listeners out there, you're kind of missing out. And let's see what we're missing out here in the world of rates out here in the land of Eurodollars. Actually, before we get to that really quickly, I'm curious, what are your thoughts since you're such a rates guy, Mr. RHOADS? I joked at the top of the show, but this was kind of a talking point for us on one of our programs earlier this week. This notion that once the Fed does their thing, right, they come out with their meetings, they make their pronouncement, and then they release their minutes, where everyone can kind of parse it if they are so inclined to go in and see what all the different Fed governors had to say. Now, after we have that, then we have these governors coming out and I guess just venting their spleen on what they think should be happening out there. That's always kind of rubbed me the wrong way. I always thought the Fed has their meeting, they make a decision, that's your pronouncement. If you want to see contrarian views and things, that's what the minutes are for. But otherwise, you know, you kind of hold your tongue until the next meeting. What are your thoughts on this kind of, I jokingly call them rogue governors, but the notion that the Fed is kind of talking out of all sides of its mouth, sir?
Well, that's, you just mentioned every economist right there. If you go back, I think it has to do with how solid the head of the Fed is. And I don't think Jerome Powell is somebody that instills fear in the other Fed governors, whereas Greenspan was always very, very adamant that we're all going to be speaking with a single voice. And since Greenspan left, and then we go Bernanke, Yellen, and where we are now, it seems like there have been more and more dissenters that talk about it publicly than they did in the past. But even if you got it's kind of like me being a libertarian, jumping up and down and saying we should have a libertarian congressman from Illinois. That ain't ever going to happen. And if you've got one or two governors that are jumping up and down saying we need to hike rates earlier, I don't know why the market would pay any attention to them. Because
it's strange to me.
They're probably not going to change things.
Yeah, obviously their voice didn't count for much, right?
Right.
So It always was strange to me when this one rogue governor can come out and just shock markets. And I don't take issue with their impact on whatever I don't care, plus or minus whatever they want to do. That's not my issue. My issue is that it should be one voice. Otherwise it leads to uncertainty in the marketplace, which we like vol, but just nonsense and noise for no reason. And I think a lot of this also is posturing as well. When anything sort of political spectrum, people want to advertise. Maybe they want to be the next Fed chairman. So if they get out there a little bit, let it be known that maybe they have a bit of a contrary opinion, then all of a sudden, bam, maybe they're on the short list for the next Fed chairperson whenever the next administration comes through. So there's a lot of that going on out there as well. So I definitely think Fed should clamp down on that. But that's the end of our Fed internal machinations discussion here on the show. But whenever you talk things like rates, stuff like that has to kind of sneak into the conversation. What isn't sneaking this week is Eurodollars doing some paper, closing in, Mr. Rhodes, on 6 million contracts, 5.9 million contracts. I'm going to go out on a limb and say this is more than pretty much everything else we're going to talk about on the rest of the show combined. So yeah, once again, I kind of use the analogy a lot when you're looking at individual trades and things in Eurodollars. It is very much like spitting into the hurricane. It is completely inconsequential. There's so much going on out there. Looks like the winner this month, or I should say this week, for the most active expiration cycle was the year 3 SEP contract. So if that confused you, check out more about Eurodollars. That's going out in a whopping 90 days. I know it's confusing. They go out multiple years, but it's still a SEP contract. That's kind of the inner workings of Eurodollars. I said it before. I think we'll have to bring on some Eurodollar specialists and really do a deep dive into all things Eurodollars for our listeners who I know are still a little bit kind of standoffish with this product, which is understandable. It's not designed for you, but we're going to try to make it a little bit more palatable for you here on the show. That contract right now, if you're wondering, this has always been fascinating to me, Russell. And maybe you've noticed this as well. Near-term Eurodollars contracts, they kind of have a vol you would expect for a rates type product. You're talking 12, 18. You get up there around 20. You get a little bit farther out a few years, Mr. Rhodes, you're talking vol in the 60s and 70s. That to me is not a rates volatility. Is that shocking to you as well?
It's shocking, but putting on my academic hat for a second, the impact of the anticipation of where rates are going to be, it's going to have a much bigger price impact on something that's 5 or 10 years out in the future than something that's near term. And I'm not going to do a lecture on duration, but that's what we're basically talking about here. Is if you're looking at a 0.25% change sometime in the near future or in the near term, the impact that's going to have on something that's a few years out, like the contracts you're talking about, that's actually going to move those prices a lot more than the near-term prices. So it's not totally out of the realm of possibilities at all, but I think it's something that leaves an awful lot of people scratching their heads.
Yeah, listen to you, the professor coming on here to lecture the listeners. You've already you've been fitting right in there at the Kelley School of Business. But you're right. It makes total sense when you think about it from an analytical perspective. But when you look at it, and then you look at, let's say, when we're going to go out a little bit longer on the curve, let's say we'll go out to the 10-year, and we're talking about a vol of a 3. It stands out by sharp contrast out there. These vols in the 50s, 60s, and 70s, and even beyond, listeners. We're getting into the 80s a little bit farther out here on some of these contracts. So never let it be said that rates can't be volatile. So of this week's action, of that nearly 6 million contracts, 18% coming in this 3-year SEP contract. It has a whopping 76 vol, listeners. It's off about 1.3 points. The skew out there, if you are so inclined, 9% rich were the puts last week, and they are unched this week, still 9% rich. So people bidding up those puts a little bit farther out, so paying a premium to that already hefty 76 volatility. So forget Bitcoin. Let's just go 3 years out in the rates. That's where you're getting some vol out here, Eurodollars at least. Up to the call side, calls were 9.2% cheap last week. This week, They are 8% cheap. So calls getting bid up ever so slightly, but still offered. It's got a bit of an equity type tilt to it, the skew out here this week. But if you're saying the most active contract wasn't that SEP contract, you would be incorrect. It was actually all the way back here in the SEP contract going out this year. This year's SEP contract. 146,000 of those bad boys trading this week. That's more than some complexes we're going to talk about out here. You can go out to soybean oil. They're not doing 146,000 contracts total. Yet these 99.5 puts here in the SEP contract going out this year, 90 days away, doing 146,000. Actually, I take it back. They were actually usurped by the 99 5/8 puts out here in August, going up this week for 168,500. And also, actually, it's all over the place. That's what's fun about Eurodollars. We actually have more than that, 99 puts, and then the 98 puts here also in SEP 3 years out, actually taking the leaderboard this week with 195,000. We have prints all over the place in Eurodollars, which makes it fun, which is why I always say, listeners, be cautious when you choose that select all on the TWIFO report, because you're going to get a lot of data coming at you very fast, which makes it fun to analyze live on a show like this. 195,000 of the 98 even puts going up in the 3-year out SEP contract. So that managed to actually take the top spot out here this week. There was one day where they didn't do much. That was Tuesday. They did 266 contracts. The rest of the week, they did a little bit more. 11,000 on Monday, 106,000 on Wednesday. I'll say that again, 106,000 just on Wednesday. I've just did this one contract in the Eurodollars. Listen, by the way, about half of that, 46,000 was closing. 25,000 more on Thursday, and a whopping 52,000 going up today. Total of nearly 200,000, 195,000. And that's just in one contract, one expiration cycle, one put, not even the calls, one put for 1 week here, nearly 200,000 contracts. This is where I talk about, listeners, when there's so much paper that it's almost overwhelming for a large amount of our listeners. Again, I want to do that deep dive into all things Eurodollars coming up on the show. We'll have to get that book. So I know a lot of you are intrigued by this, but also at the same time, it's just like a tidal wave washing over you. So finding some nuggets of info, some analysis that you could sink your teeth into for all things Eurodollars and make sense of, it's going to be one of our missions here on the show for you this year. Mr. Rhodes, anything else to add on Eurodollars before we keep on rolling to our next product category, sir?
Well, I do think that the one that you cited as the highest volume, a couple of years out or so, I think that's where people think the next hike's going to be now. It's interesting how the volume targets, kind of the price level that was, or the time frame that was being indicated last week by the Fed that they think they may not hike until then. My impression was it was fall of 2023 that we might not, that we're not going to have the Fed do anything until then.
We shall see, listeners. Who knows? As we keep on rolling, Mr. Rhodes is joining us here on the show, and he's not talking rates. He's usually hanging his hat in the world of equity volatility. So let's head out there next.
It's time to explore the volatility swings, skew changes, and hot options trades in your favorite indices. It's time to talk equities.
All right, everybody. Welcome to the equities segment. You know, when you're talking equities, the flip side of that coin is volatility. So let's run it down here, set the table. What's going on in the world of equity volatility right now? Coming into today's show, as we were just joking about on the option block not too long ago, we finally have that 15 handle, that much ballyhooed 15 handle in VIX cash that our friend the Rock Lobster was predicting last week on Friday. It took a little bit longer to get there, but we did finally get there. About 15 3/4 coming into showtime. Puts it down about 1.5 points from last show. That's, again, if it closes there today, that would be the lowest close since the pandemic from a vol perspective. So pretty important levels we're seeing out there right now. VVIX, a.k.a. the volatility of volatility, at about a 107, about 106 3/4 coming into showtime, puts it down nearly 14 points. And we have good old VolQ at about a 1585 or so, puts it down about 0.85 from our last show. And again, that's a lot lower. VolQ was locked around the 22 level for quite some time. We used to joke, didn't seem like it could budge. But now at the money vol in the NASDAQ, finally coming in, that puts, I forgot the biggest one of all, RVX at the top there. Nearly a 22 out there, 2188, down about almost 1.5 points from where it was this time last show. Sean and I were just talking last week, and Catherine was joining in with us as well, saying, can RVX do it? Can it make it below the 20 handle? I mean, VIX just broke 16, so it seems like the sky's the limit to the downside, at least this week. But this week, not so much. 21.88 coming into showtime. So that puts that VIX to RVX spread, so the large cap to small cap vol spread, at about a little over 6 points, about almost 6.25 points. Slightly wider than last week, about 0.1, about kind of unched from where it was this time last week. Both VIX cash and RVX down similar amounts this week. And the VIX to vol Q, a.k.a. the S&P 500 to the NASDAQ vol spread, almost even, 0.12. That's about a quarter of a point tighter. And again, kind of reflecting what I've been saying for a while, how some of the top holdings out there in the NASDAQ and the S&P aren't too dissimilar from each other. So that's why we're seeing a little bit of syncing up, it seems like, there from a vol perspective. Mr. Rhodes, let's start there. You have worn the vol hat once or twice here in the past. What are your thoughts on the ever-evaporating world of equity volatility these days, sir?
Well, did you see that we did have a 14 handle in VIX in the pre-market today, but I think that was the typical early morning spike down that recovers within 30 seconds.
I'm sure once you saw that, you were offended and immediately bought it all up because you love nothing but VIX upside.
Yeah, I'm the one that pushed that one up. And before I get a bunch of emails saying how can I do that as well, you can't trade spot VIX. So we are joking about that. I made a joke in passing about taking advantage of the Friday and Monday stuff, and I'm not going to dig beyond that today because I talk about it all the time. But the weekend impact on VIX, and I got tons of emails asking me how to go about trading it, and I'm like, oh my God, did you not hear me say you can't trade spot VIX? So, but sometimes in the early hours of the day, as everybody's resetting their quotes and waking up, we'll see a very brief spike down in VIX, and it got down to about 1450 or so. I'd put an asterisk next to that and say that it still is holding above 15. Doing some quick math in my head, 6 over 15, that gives us about 30%, 40% or so premium of Russell volatility to VIX. That's actually at the lower end of where it's been on average this year. It's been higher, more in the 40 to 50% range for most of the year. Part of that was because we were seeing upside call buying, something that Sean astutely pointed out. There was an actual fear of missing out volatility boost to Russell 2000 index option volatility, but that hasn't been holding up, and that's probably why the spread between the two is narrowing. As far as NASDAQ versus S&P volatility, it's the quiet before the earnings storm. Just wait about a week. And this time next week, when a big portion of NASDAQ companies are set to report within 30 days, you're going to see that widen out for sure. It's a seasonal thing that happens, and we're just about at the moment where that's hitting the bottom and getting ready to spread back out.
Speaking of seasonal things, sir, it is that time of year. We just had Catherine Yoshimoto joining Sean on the show and myself last week talking about all things Recon. It's a big week. You can argue it's kind of the biggest week of the year out there for all things small cap. And it's been a crazy year for the Russell 2000, especially since last election last year. It was kind of all upside. It was kind of like its own crypto out there for a while there. Just nothing but upside. Folks discovering it, gobbling up the small delta calls. Crypto, meme stock, pick your analogy. They all were kind of apt there for a while. It has settled down a little bit. And now, of course, we have hit the big week here. This Friday, June 25th, we have the Recon going final after the close of equity markets. And then this Monday, the 28th, they reopen with the newly reconstituted Russell indexes out there. So all of you out there like a little bit of rebalance action coming up for you this week. We had an interesting discussion point, interesting user question on the show recently, Russell. I'd be curious to get your thoughts on it as well before we dive into the Russell action. A listener asked, the Russell Recon takes place in a microsecond after the close. So the exact impact of the event itself on volatility is minuscule, really. But they had a question, which I thought was kind of interesting. What about in the lead up to and the week, let's say the week or so leading up, maybe 2 weeks, and the week or so coming out of Recon? What is the impact on vol there? I thought that was an intriguing question. So I don't have the listeners' names. I don't have a chance to give them credit. But what are your thoughts on that, sir? what would you think the effect would be, if any?
Well, I know what the effect is because I run all the numbers over and over and over again every year, and it's pretty much a non-event with respect to looking at Russell 2000 implied volatility against itself. If you take just kind of the average of where RVX is around Recon versus the average of where it is the rest of the year, it's slightly lower than the long-term average. Just in this time period, June, if you ranked the months by average RVX closes, June ranks 7th out of 12, so it's not giving too much of a boost there. The one place that I did find a slight difference is when you compare Russell 2000 volatility to VIX. When you compare RVX to VIX, that relative premium is a little bit wider with RVX being a little bit more elevated relative to VIX, but not to the point where if you're looking at a screen and not pulling all the historical numbers and looking at it, not to where it's not noticeable to the naked eye. How's that? It's a small anomaly, and it really is a big tribute to how smooth and how transparent the Russell reconstitution process is every single year. They let you know what stocks it's going to be. They actually basically let us know what stocks that are going in and going out on June 4th. So everybody's had a lot of time to prepare for that. It's a gigantic crossing trade. Last year, a little bit more was crossed at NASDAQ than the NYSE, but collectively it was well over 1 billion shares changing hands on the last second or last millisecond before the close of the day. And it really does not have that much of an impact on the price of the stocks. The only study that I saw, and I want to find the study again. I read it once and then I lost it because it made me so angry. But I saw a study talking about how if you were to identify what stocks were going into the Russell 2000 like 6 months in advance and buy them, then you could actually make money. Well, no kidding, because the Russell 1000, if you're going from the 2000 to the 1000, that means that you performed well relative to a bunch of other stocks. So, yeah, if you know what's going in 6 months in advance, well, you basically know what the best performing small cap stocks are going to be. So the look back bias on that was just absolutely ridiculous. And needless to say, it was written by some academic who just saw something in the numbers but did not apply logic whatsoever.
Yeah, I don't think Russell even knows 6 months ahead of time who the hell is going into the rebalancing. So if you have a crystal ball, you can make money in the market. If that was the case, I probably might be looking even crazier than just the Russell Recon names, right? I'd be going out to the crappy biotech that's trading 3 cents now and is going to be $1,000 by the end of the year, something, or maybe a Dogecoin, something along those lines, where you're getting those multiple 1,000% returns, right?
And you know as well as anybody else how horrible I am, even with a crystal ball.
Yes, the crystal ball was not exactly your most successful segment, shall we say, back on your extended run over there on the crystal ball. Let's see what's going up here this week from a Russell 2000 perspective out here on CME. And it's kind of a light week, I think, reflecting the fact a lot of people are keeping their powder dry ahead of the big Recon coming up on Friday. It'd be interesting to see if we see a little bit more paper hitting the tape this time next week. But folks, like Russell mentioned, folks are asking about out of the money calls, the quote unquote small delta calls. They are still pretty active. We're at about 23.30 right now in the Russell 2000 listener. That's up about a little over 2% on the week. And the 24.30 calls going out in 2 weeks. So actually, that's pretty long term for Russell. Usually have things going out in the day that are pretty active. Those are one of the leading contracts out here. So 100 handles. I'll put it up to you if you think that's small delta or not. But still, interesting stuff nonetheless. But actually, the most active contract are the 2200 puts, I should say, out here in July. They have about 35 days to go. Let's hang our hat out there in July because that's where the most action was. The vol, by the way, if you're wondering, 1837. So it's already below 20 when you go a little bit farther out. Obviously, RVX is the VIX calculation, so it pretty much uses a 30-day measure. But you get a little bit beyond that here in the Russell options, and you're already well shy of a 20. 1837 off about 1 1/3 points from a vol perspective this week. Skew-wise, the puts last week, 15.3% rich. This week, they were at about a 17% out there. So a lot of action on the puts. Calls last week, 11.5% cheap. This week, 12.5% cheap And the most active contract out here, as I mentioned, was the 2200 puts. Given the fact that the put wing got bid up a little bit, I'm going to guess folks were probably buying those bad boys. That contract was actually pretty active all week long. The most active day was Tuesday, and that was all opening all week. So it's like some folks loading up on a little bit of downside. Not quite as far out as they usually go. Usually they'll go out 3, 4, 6 months on the puts. These only going out about 35 days. So interesting paper, but again, not a ton of it this week, which is probably to be expected. The big recon coming up in a little bit. We'll see how all of that impacts things going forward. Mr. Rhodes, we had a lot of stuff lighting up our movers and shakers this week, all sorts of complexes. So where should we move our journey next, sir?
How about we run to energy? A couple of those were on the light side.
There was a little bit of energy lighting it up, so away to energy we go.
It's time to tap into the deep options well of black gold, Texas tea, nat gas, and more. It's time to talk energy.
All right, listeners. We had some energy lighting up the upside. We had heating oil number 5 up 4.25%, and RBOB up number 4 up 6.18%. Fortunately, not a lot of really options paper in either of those worth parsing. So let's head on out to the product I know a lot of you watch, and I know a lot of you are interested in. It was right outside the top 5. I think it was number 7 or 8 out there. It was WTI, still managing to hold up north of the 70 handle, 70.60 coming into today's show, up about 1.75% just on the week out here. And let's see, where are we looking here? From a overall action perspective, it was out in that August contract where the action was this week in WTI. By the way, how much action? A little bit light in WTI as well. 362,000 contracts. Usually they're closing in on 500,000 at this point. So just a little bit light here this week across the board. It's outside of Eurodollars, which were once again on fire. Let's see. And the vol out here in this contract, listeners, that has, 34 days to go is about a 30, almost 31, about 30 and a half or so. That's up about exactly a point from this time last week. So again, if you're looking for a little bit more juice, you're kind of wringing your hands saying this equity vol is getting a little anemic. A little bit more juice out there to be found in WTI right now in terms of the skew. And by the way, that AUG contract did about almost 40% of the paper this week, 39%. So let's look at the skew out there. The puts last week, 7.8% rich to the at the money this week, 7.3%. So the puts coming in a little bit. The calls last week, 3.3% cheap. This week, 5.8% cheap. And in terms, so calls getting hit a little bit, the puts bid up ever so slightly. And in terms of the most active contract out here this week, it was that August 73 call, doing nearly 13,000 contracts. The most active day this week was Wednesday, 7,275 of that nearly 13,000 going up on Wednesday, ever so slightly closing. So a little bit of bias to the closing this week, but looks like a lot of churn and burn on that 73 strike. Can we make it to 73? Is that a bit of a bridge too far? By August, probably was driving a lot of that paper out there. Also 70 calls. Actually, I take it back. The August 70 calls out here in September did slightly a little bit more. Just a little bit more. 14,600 this week. So they're actually on number 1. Their most active day actually was Monday. 6,500 going up on Monday, 4,200 on Wednesday. The rest kind of scattered throughout the weeks. Mostly closing, but ever so slightly. Again, a lot of churn on the 70 strike. That makes more sense. I expected, given the fact that we're flirting around the 70 strike, I expected a 70 strike to be in our kind of top most active strikes this week, and they did not disappoint. It was just out in September as opposed to August. If you like a little bit more upside out to Dees, it was the 80 calls that were lighting it up to the tune of about nearly 8,000 this week. The big day, about half of it coming on Tuesday, 4,200, most of that closing. So maybe some folks deciding to get the heck out of Dodge on the 80 strike on Tuesday in December, saying, yeah, I don't know if that's might be a bridge too far out there. Maybe they were overwriting those and decided to take them off. Let's look really quickly at the call wing. Maybe we can analyze a little bit what was going on out there in Dees. The calls last week, 6.1% cheap. This week, 6.8% cheap. So it looks like some folks overwriting a little bit of calls out here in Dees over the course of the past week. And that's not enough for you, listeners. That's not optimistic enough for you. Dees of next year, Dees of 2022, the 90s were trading pretty actively this week, almost 6,000. Of that, 5,250 were going up today. It's a lot of paper to go up in the 90s out here in Dees of 2022. Also looks like 2,600 of the pars went up. So that would be 1 by 2 if they were so inclined. 90 par, but doing it the other way. It's 2x1, 5,250 by 2,600. So that would be an interesting one if that was the way they wanted to go. But either way, interesting ratios to the upside. Mr. Rhodes, I know you like watching all things energy from a vol, from a skew, from every other perspective. What's been catching your eye out here in the world of energy, sir?
I'm surprised that energy's held up in the 70s as long as it has. I when we did the question show, I got a question about energy, and without flinching, making that very quick decision, I said, energy's going down from here. Oil's going down from here. And it's up slightly from when I pronounced that about a week and 2 days ago. But when you see the skew a little bit more concerned about or kind of giving up on the upside, I guess I should say, I start to think that oil's going to, or whatever commodity we're talking about, because the skew, I think, does give you a lot of hints as to what people are worried about. That when you mention that 100 strike price at the end of next year, I automatically think somebody's maybe putting on a position that's going to help them out in case we get hit with a little bit of inflation. Just something that might push the whole curve up higher across the board. Or they think World War III is kicking off sometime in 2022 and they want to be ready for the geopolitical conflict.
But you're an economist. You pull energy out of it doesn't count. It's not real inflation, right?
Yeah, that's right, because it doesn't go in the economic number. So
exactly. It's not real inflation.
We don't drive anywhere and we don't eat anything.
It doesn't really impact our lives in any material way. The dismal science. They call it that for a reason. But you mentioned the $100 strike oil calls here. The Wall Street Journal jumping in on this trend, too. They put out a chart in one of their newsletters recently talking about the energy options traders betting on $100 a barrel of oil. They have a chart here of the OI effectively on the 100 strike kind of across the board and how it has really gapped up over the course of the past few months. And they use a platform we're kind of familiar with here on the show to do it. They use the Quick Strike platform. So Wall Street Journal waking up to the fact that Quick Strike has some cool analytics over there. Glad to see them using Nick's platform out there. And if you're saying, I like all this WTI stuff, but maybe it's a little bit too rich for your blood, or the contract's a little bit too beefy. You're not an industrial refiner. You don't need that much size on WTI. Well, some good news for you out there, listener. CME has been hitting about this WTI micro. Everything small is enormous at CME these days, and micro WTI futures are on the way, listeners. They are expected to list coming up pretty soon, July 12th, pending regulatory approval, of course. So there you go. If you said, hey, I like the WTI, but I need something maybe, let's say, 1/10 the size of that to fit into my account a little bit better, CME helping you out there. There's going to be micros for pretty much everything across the board out there. So things are letting up. By the way, we kind of buried the lead on the last segment on equities out there. Also, micro E-mini futures, micro E-mini equity options also blowing the doors off it out there. 1.5 million contracts traded just last Friday. So the micro futures were a big hit. The options on said micro futures in the equity world have been a big hit. We've got the micro futures now in Bitcoin. We're coming up on micro WTI. Pretty soon, listeners, you'll be able to trade a micro. And it's about everything else on the freaking planet. So a lot to look forward to if you're in the retail side and you want to have a little bit more bite-sized contracts to play with across the board. I don't care what it is. If it's rates, if it's energy, if it's equities, if it's ags, something small, something bite-sized is coming your way out there from CME. Mr. Rhodes, what say you, sure? Should we try to squeeze one more in, or should we head right to the listeners?
I like answering questions.
I know you do. You did a little bit of it recently.
I like thinking on my toes.
All right, so let's go for it then. Get some of your questions on. It is time for the Futures Options Feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/theoptionsinsider, stocktwits.com/optionsinsider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's Mixlr.com.
All right, everybody, let's get out to the questions. You guys know how to get at us at most social media platforms, just at Options. Of course, if you're a member, you listen live, you can get bumped up to the top of the list, or you can send it in via our members hotline, just like our member does here, Mr. Luigi. He asked us recently on the show, I think it was last week on TWIFO, about a fund out here called DBC. He wanted to know if we liked it, if we knew much about it. That was his preferred way to get commodity exposure, because he's like a lot of you listeners out there. He has primarily, an equity options account, but he wants to get, listening to a show like this, he obviously wants to get exposure, hasn't taken that step yet of opening up the futures account. So he was looking into maybe trading this DBC. So yes, because you asked so nicely, Mr. Luigi, we did look into this a little bit for you. This is the Invesco, in case you're not familiar, listeners, is the Invesco DB Commodity Index Tracking Fund. Say that 5 times fast. This is a rules-based index comprised of futures contracts on 14 of the most heavily traded and important, put those in quotes, important physical commodities in the world. The fund and the index are rebalanced and reconstituted annually in November. So what does it hold of those 14? Well, it's pretty heavy on energy. It's got WTI, it's got heating oil, it's got RBOB and nat gas and Brent. So what is that? 5 of the 14 are in the energy sector. So hopefully you like some energy, because you're getting a lot of it there. Been good probably so far this year. Metals, you got gold, silver, aluminum for the Brits, and zinc. So they go beyond the precious. They get out into some of the other metals there as well. Oh, and copper grade A. So you got there as well. You got 5 metals as well. So already we got 5 of the 14. We got 5 energy and 5 metals. Interesting. Then we got corn, wheat, and soybeans, and sugar. So there you go. That is the entirety of this complex. No rates exposure, but they do mention, I think, that they hold some of the cash in, some kind of rates equivalent. So you get a little bit of rates exposure there as well. So how does this work? One of the things that always makes me leery about these types of funds is, first off, how do they try to replicate their exposure? Are they using futures? In this case, the answer is yes. So then the next question I always have for these is, how do they utilize those futures? Is it something like, let's say, like a VXX, some of these vol products we have out there, or a USO, all these other ones out there that try to replicate the underlying using a basket of futures, or maybe sometimes it's one monthly future that they rebalance every month. And it's all sorts of disaster. When you get into the contango, you get this negative roll yield, which means, of course, effectively you're going out there, you're buying more expensive, longer-term contracts, and you're selling cheaper, nearer-dated contracts as you're moving down that contango curve. And as a result, you're usually getting impacted pretty severely. So that's always the question with these funds. What are they doing about that? And to their credit, these funds are not idiots. They know this exists. So what do these funds do for this? Oh, by the way, if you're wondering if this fund is up 27% year to date, it seems like it's about exactly the same as another big fund out there, the S&P GSCI Commodity Index. So how do they deal with this? So that's what I wanted to know about this fund. So I did a little digging into the prospectus for you here, Luigi. And they say this fund, they roll from one futures contract to another futures contract that is, in quote, intended to generate the most favorable implied roll yield under prevailing market conditions, rather than rolling to a new futures contract based on a predetermined schedule. For example, monthly. I like that. I like that, and I'm a little bit of pause for that as well, because the nice thing about that is that, hey, they are aware of this. They are aware of this effect. They are not idiots. They know that this is the primary drag on their portfolio. So what they're doing is actively managing this and saying, hey, we like how this term structure is shaping up. We're going to go out, let's say 3 months right now, or maybe we're going to go front month, or maybe we're going 6 months. They use their own analysis to try to minimize the impact of that negative roll yield. So I like that. That's a good thing. You're not just on this every month schedule, and then you just deal with the roll yield, and it's going to be a disaster. So they're trying to deal with that. The downside of that potentially is, I don't know how good these managers are. So that's the question. I need to look into that to see how good they are at actually minimizing. So now you have some human factor baked in this. That could be a negative if you like your things reliable and stalwart and easily predictable. But for me, they're making some effort, so I do kind of like that. I'll have to look now and see how that's played out over time from a performance perspective. But an interesting one. Mr. Rhodes, do you have any thoughts here on this DBC commodity fund? Do you have any experience with it, any knowledge of it? And then B, your thoughts in general on the issue that plagues a lot of these funds, which is that negative roll yield and how they get around it.
Well, they're definitely getting that. Was you and I, great minds thinking alike and all that. I had the exact same thought. Was, oh my God, if they're owning futures on 14, 15 markets here, what is the role?
That's a recipe for disaster.
Especially when you see WTI as their biggest holding. And we were just talking about it. The curve's inverted on WTI right now. The August contract had a 73 handle, and I think the December contract had a 70 handle. So if you were going with always holding the front month, you're going to give up 3 points, just all else being the same as you roll down through the end of the year. A negative behind that can also be how reactive is the December contract to a big spike in the spot WTI. If we do get a bad inflation number or a bad transitory inflation number, and we get a short-term move higher or what's going to believe to be a short-term move higher in energy, that December contract's not going to benefit as much. So it might be like owning one of the volatility derivatives where VIX spikes up a lot, and you're like, well, why did my ETF go up as much? Well, it's the same thing here. Having longer dated futures, they're going to be less sensitive to what's going on in the spot market. So you might not get what you're hoping for. The other thing that concerned me a bit is, this is an energy fund. It's 62.25% in energy right now. And, if energy's already had its move and you're taking a look at buying something that you think gives you diversification toward commodities, because if we get inflation, commodities are all going to go up. Well, if the energy market's already discounted it, you're, again, not going to get the benefit that you're hoping for. So, again, going back to the academic hat, you would need to think of this fund with respect to your macro outlook, but also as the portfolio it's holding and not just a pure commodity play.
Yeah, that definitely struck me as well. It's very heavy on energy, which so far has worked out. You can't argue against it. And that could go back, maybe we were talking about some of that active management they do on this. They decided energy was poised for retracement. Are they going to scale that back now? I mean, that's the kind of the big question on this fund is the active management side. How are they going to use the futures? And as we also pointed out, there is no free lunch. You want to avoid the negative roll yield, so you roll a little bit farther out, but now your tracking of that underlying is going to be a little bit more muted as a result. So there is no free lunch. There is no silver bullet to say this is the best way to do one of these types of things. It's all very highly subjective. And so that's what makes these types of funds so interesting and so fascinating and sometimes so terrible, because they do a terrible job. It's hard. That's why some funds just wash their hands of it and say, I'm just going to do it every month like clockwork, and, consequences be damned. If we erode, 100% over X number of years, so what? We'll just reverse split. So that's how some funds deal with that. Other funds decide to try to actively fight it, and it's a challenge. But if you can do it well, it's interesting. But yeah, that was another thing that stood out to me, Mr. Rhodes, is that this is, I think calling this a commodity fund is a little bit generous. It's an energy and then some metals and then a dabbling of ags. And that's kind of really it. So if you want a diversified, broad spectrum of commodities, perhaps this is not the one for you. But a great question. I'm sure a lot of you out there are in a similar boat. And this is an issue that plagues particularly the audience of this show. They want to trade this stuff. They listen to a show like this. They want to get in, but they can't trade Eurodollars. It's too big. Even WTI is kind of too big for a lot of them. So how can they get exposure to this stuff? Some of them are still hesitant to pull the trigger on a futures account, even though that's gotten a lot easier. If you have an account at one of the big retail brokers, your TDs or everything else, it's kind of just hitting another button. And they even try to do a great job of trying to aggregate it so it looks like you have one account. It's really much more streamlined than it used to be even 4 or 5 years ago. So if that's your stumbling block, I wouldn't be as concerned about that. You get a lot of great margin benefits. We've said it before out here, tax benefits from trading the futures. So we would encourage you whenever possible to kind of do the end run around these funds and go try it for yourself. But I know that's still not everyone's ready to pull that trigger. So this one's an interesting one, worth watching, but a lot of questions, a lot of caveats about it. And it's had a nice little pop. Maybe it's time to maybe scale some of that back unless they are going to change their holdings, which again, this is an actively managed fund. So it'll be interesting to see what they do with that going forward. We got time here, looks like, for one more. Let's go out to Aston Crouch sent in a comment, said, we come into the showtime, we talked about how oil rose to fresh multi-year highs on demand recovery. And he liked that and said, you mean so they're not overstoring their oil like in 2015? So thanks and great show. So yeah. I guess there's some of that there. The storage side, obviously a big issue. We saw that, just last year, April of last year, 2020, right? And how the storage, or perhaps lack thereof, can be a big issue in the crude space. So thanks for that. Glad you're enjoying the shows out there, Aston, as well. All right, everybody. That music means we've come to the end of another journey through the world of all things futures, options. Touched on a lot of stuff this week. Got into the equities, got into the rates. Mr. Rhodes here, so we're going to do both of those. Squeezed in some energy. Talked about an interesting fund you may want to check out, maybe not, depending on your thoughts out there. But before we go, Mr. Rhodes, if folks are intrigued, they want to learn more about all things going on in the world of your namesake, which is FTSE Russell and indeed the Russell 2000. Where should they go? What should they do, sir?
Well, you can always go to the FTSE Russell website. You can go to CME Group, and you can go to the SIBO websites, because that's where all the great Russell-related derivatives trade. And then as far as me, when I talk about those markets, and I'm actually going to be talking about the Russell 2000. I already wrote something about the Recon that's at EQDerivatives.com, basically saying what I already said here, that it's not that much of an event to get excited about. But yeah, and trying to figure out an edge on trading it is pretty darn difficult. I'll expand on that a little bit more at EQ Derivatives tomorrow. And also, I've noticed more and more of the mini RUT index option trades. And I want to highlight a few of those that have come across the tape as well. But so I'll be talking Russell on Russell a little bit more tomorrow.
Russell on Russell, I like that. You want more of that? Stay tuned for TWIFO coming up. Mr. Rhodes may be making some more appearances here for the Russell on Russell segment. I like that. We have to add some new music in your near future, Mr. Rhodes. In the meantime, of course, you know where to go to check it all out. FTSE Russell, FTSE Russell.com is the place to go for all that research, that webinar that Catherine mentioned, where they talked about the use of derivatives around Russell 2000. All of that last week can be found at FTSERussell.com. Give them a follow on the old Twitters as well. Get all their research and stuff they have coming out in between episodes of the show. At FTSE Russell is the place to go. You know where to go for all this data from the land of CME. CMEgroup.com/TWIFO or /TWIO. Both of them get you to what I think is the best thing over there on the CME website. They have a lot of cool stuff. I like their research and the Fed Watch, everything else. But the coolest thing, of course, are our TWIFO reports. So check them out. CMEgroup.com/TWIFO is the place to go to begin your journey to the world of futures options. Perhaps we'll lure you to the dark side. On behalf of everybody over there at CME, everybody over there at FTSE Russell, and Mr. Rhodes, a.k.a. Russell on Russell, and indeed myself, I want to thank all of you out there for downloading, streaming, subscribing. If you are members, you're listening live, welcome to all of you as well. We'll be back again tomorrow, noon Central, 1 p.m. Eastern, to talk some vol. All things volatility views. And for our members, we're back again right after that, about an hour later, to bring back options oddities. That's a fun one. A lot of you are enjoying that one as well. I do believe the Rock Lobster will be joining me for that as well. The guy used to host that show. So a lot of fun to be had there. Then we're back again next Thursday, another episode of This Week in Futures Options.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, Visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.